Hey everyone, hope you're having a great summer so far. Jim Sr. and Jim from Platania Financial here to present our 2022 Mid-Year Market Outlook. Stay tuned.
Today I'm going to cover a few slides regarding the economy. Then Jim will cover stocks and bonds, and then I'll conclude with some information about the midterm elections. Now, so far this year, the market hasn't been as bad as the financial crisis in 2008 or during the pandemic, but the ride has not been a fun one, and it's been very bumpy to say the least. Regarding the economy, LPL Financial Research has given us some guidance. They believe that the U.S. economy would continue to grow this year between 1.9 and 2.5%. However, they do see a slower growth next year. Now, just before this recording, a couple hours ago, it was announced that the second quarter's GDP was negative, but real consumer spending rose 1%. Although the economy has shrunk now for 2 consecutive quarters, LPL Research believes we are not in a recession due to the strong consumer and low unemployment rate. Regarding inflation, they project inflation at 6.6 to 7.2% this year. However, they see it slowing down next year, somewhere between 3.5 and 4.1%. Supply chain bottlenecks are improving. That's really positive. Recent reports from the Institute of Supply Management show that order backlogs are declining for both the services and manufacturing sectors. And this is one of the reasons they're fairly optimistic that we can avert a recession from now. Consumer spending will slow during the remainder of this year, largely due to wages that have not kept pace with inflation. But the good news is both debt service and financial obligation ratios have declined since 2008. And a real cushion for consumers is that nearly $3 trillion of excess savings accumulated during the pandemic. So when consumers likely start tapping into credit, which we think that they will, they'll hopefully do so without reaching unstable levels due to the low amount of consumer debt they're starting with.
Stocks face a number of headwinds in the second half of this year, but the amount of turbulence will likely depend on the pace at which inflation falls. Tough to see the bull case with everything going on right now, but an improved macroeconomic environment may set the stage for higher valuations, further earnings growth, and solid gains for stocks over the rest of the year. So one of the main questions out there is how long will it take for stocks to return to prior highs? That will largely depend on the path of inflation. Lower inflation tends to bring higher valuations, and it is our view that inflation has peaked or is on the verge of peaking. Just look at many of the areas that have seen rising prices the past year and the subsequent reversals that have taken place. We've likely seen a peak in wages, housing, car prices, corn and wheat prices. Gas, energy, and commodities prices have all declined significantly in the recent months. If inflation gets under control, we're likely to see more stability and less uncertainty return to the economy and the markets. The market clearly does not expect 8% inflation to persist based on current stock valuations. But whether inflation eventually settles at 2%, 3%, or 4% will go a long way towards determining how much higher stock valuations can go from current levels. First quarter earnings season wasn't exactly pretty, but given the difficult environment, a roughly 10% increase in S&P 500 earnings per share and nearly 14% increase in revenue, both solidly above expectations, were excellent results. So far in 2022, companies have generally been able to pass through price increases to limit pressure on profit margins amid the higher materials and transportation costs, the labor shortages, and the rising wages, along with various other supply chain disruptions. Second quarter earnings season is underway as well. And so far, earnings are a bit lower, but revenue growth is still strong. Given our inflation outlook and some indications that global supply chain challenges have been easing, we expect mid to high single-digit earnings growth this year and next to help support a stock market turnaround in the months ahead. The value proposition for core bonds, as defined by the bonds within the Bloomberg Aggregate Bond Index, is that they tend to provide liquidity, diversification, and positive total returns to portfolios. Despite the historically poor start to the year, the value proposition for core bonds has actually improved. Remember, investing is a forward-looking exercise, and with the backup in yields that has already taken place this year, we believe now could be as good as it's been in quite some time for core bonds. Important to note, the relative attractiveness of equities over fixed income was undeniable when interest rates were hovering around all-time lows. Now that interest rates have moved higher recently, the relative attractiveness between stocks and bonds is much more balanced. But for investors unwilling or uninterested in taking on additional equity risk, there are a number of fixed income markets with yields trading above long-term averages. The yield on most fixed income asset classes is hovering around the highest levels we've seen in a decade. And while we can't guarantee that interest rates won't go higher, at current yields, the risk return for owning fixed income has improved dramatically, in our opinion. Now that interest rates have soared off of the all-time lows set back in August of 2020, there's more of a cushion to act like a diversifier during equity market drawdowns. The backup in yields this year has certainly been painful, but the ability for fixed income to act as an equity buffer has increased in our view. As bond and equity markets both move past the aggressive repricing of Fed rate hikes that have caused both markets to sell off this year and grapple with the potential slowdown in economic growth, we believe bonds are likely to provide that safety net for portfolios again as we move through the year.
Midterm elections are often a balancing act for voters, historically tilting heavily against the sitting president's party. Since 1900, the president's party has lost House seats in midterms 87% of the time, and in the Senate, 67% of the time. The year after midterm elections has historically been quite strong for stocks. The S&P 500 has been higher 1 year after every midterm election since 1950. That is 18 out of 18 years, with an average gain a year later being up 14.5%. Markets hate uncertainty, and we know that midterm elections can bring a lot of uncertainty to the markets. What could it mean if history repeats itself and the Republicans take over both the House and the Senate this November? Well, one of the best scenarios under a Democratic president is Republican control of Congress, with the S&P 500 up an average of 16.3% during those years. What if the Democrats hold on to the Senate but lose the House? The second most likely scenario. A combination is also quite strong for the stock market as well, with S&P 500 getting 13.6% on average during those years. In conclusion, it's been a challenging year so far for stocks and bonds. We do, however, feel cautiously optimistic that both stocks and bonds will be higher 6 to 12 months from now. Well, thanks for listening to our Midyear Outlook. If you have any questions regarding the information we talked about or your overall retirement investment plan, please don't hesitate to give us a call at 847-870-7526. Enjoy the rest of summer.
Thanks, guys. Take care.
Please take a moment to read these important disclosures.